studying your last two. I swim med when I turned in. The staring down to mute. And can learn a pole that some kid died.
In the previous sections, we learned how investment activity can be tracked through brokerage statements, transaction reports, working papers, and supporting documentation. While that detailed approach provides excellent support and analysis, it is not always necessary. This slide introduces an alternative approach known as Methodology 2, recording investment income directly from T-slips. As the name suggests, this method uses T3 and T5 slips as the primary source of investment income information. Let's compare the two approaches. On the left side of the slide, we see the traditional process. An accountant may review brokerage statements, trade confirmations, monthly statements, gain and loss reports, and distribution reports. From those documents, detailed working papers are prepared. The working papers are then used to create journal entries, which flow into the financial statements and ultimately into the T2 return. This approach provides a high level of detail, but it also requires more time and effort. Now look at the right side of the slide. With Methodology 2, the process becomes much simpler. Instead of analyzing numerous investment documents, the accountant starts with the T3 and T5 slips. The information from those slips is used to prepare journal entries directly. Those journal entries update the financial statements, which then support the preparation of the T2 corporate tax return. Notice the shortcut highway shown in the center. It represents the key advantage of this methodology. The accountant can move from tax slips to accounting records much more quickly. For many small corporations with relatively straightforward investment portfolios, this can be an efficient and practical solution. The method is often described as faster, simpler, and more efficient because it reduces the amount of detailed transaction analysis that must be performed. However, it is important to understand what this method is actually doing. It is not ignoring accounting principles. The accountant is still preparing journal entries. Financial statements are still being produced, and the T2 return is still based on accounting records. The difference is simply that the T-slips become the starting point for the accounting entries. At the bottom of the slide, you can see the comparison clearly. The traditional route involves many documents, working papers, and then journal entries. Methodology 2 starts directly with the T3 and T5 slips and moves straight to the journal entries. This significantly reduces the amount of preparation work required. The key lesson from this slide is highlighted in the banner at the bottom. Use tax slips as the primary source of investment income information. When appropriate, T3 and T5 slips can provide a practical and efficient foundation for recording investment income. They allow the accountant to prepare accurate journal entries without performing a full transaction-by-transaction analysis of the investment portfolio. In short, Methodology 2 is a streamlined approach that uses tax slips as the starting point for accounting, helping accountants prepare financial statements and T2 returns more efficiently when the circumstances are suitable. Now that we've introduced Methodology 2, let's walk through exactly how Trident records investment income directly from T-slips. The key idea behind this method is simple. The T-slip becomes the starting point for the accounting entry. Let's begin with the T5 slip workflow shown at the top of the slide. A T5 slip is typically issued for investment income, such as interest earned from GICs, savings accounts, bonds, or similar investments. The process starts when Trident receives the T5 slip. The accountant reviews the slip and identifies the amount of interest income reported. Once the amount has been verified, a journal entry is prepared. The entry records the interest income and updates the appropriate accounts. After the journal entry is posted, the information flows into the financial statements. As a result, the interest income appears on the corporation's income statement and becomes part of the year's reported earnings. Notice how streamlined the process is. There is no need to review dozens of brokerage statements or prepare extensive working papers. The accountant relies on the T5 slip as the source document and records the accounting entry directly from it. Now let's look at the T3 slip workflow shown at the bottom of the slide. Unlike a T5 slip, a T3 slip is usually more complex because it often contains multiple income components. The accountant begins by reviewing the T3 slip and identifying each component separately. The slip may contain interest income, eligible dividends, capital gains, foreign income, and return of capital. Rather than recording one single entry, the accountant separates each component and prepares the appropriate journal entries. Interest income is recorded separately. Dividend income is recorded separately. Capital gains are recorded separately. Foreign income is recorded separately. And return of capital receives its own unique treatment because it is not income. Instead, return of capital reduces the carrying value or adjusted cost base of the investment. Once these entries are recorded, the information flows into the financial statements. The income statement reflects the various income components. The balance sheet reflects any adjustments to the investment asset caused by return of capital. This process ensures that the accounting records accurately mirror the information provided on the T3 slip. One of the most important observations from this slide is that the accountant is not starting with brokerage transactions. The accountant is starting with the tax slips themselves. The slips provide the information needed to create the accounting entries. This is what makes methodology 2 so efficient. Instead of reconstructing investment activity from numerous supporting documents, the accountant uses the tax reporting documents as the primary source of information. The key takeaway is highlighted at the bottom of the slide. The T-slip becomes the starting point for the accounting entry. Whether the source document is a T5 slip containing interest income or a T3 slip containing multiple investment income components, the accountant uses the information provided on the slip to prepare the journal entries that ultimately flow into the financial statements and support the corporation's T2 return. This is the practical workflow that defines methodology 2. By now, we've seen how methodology 2 allows Trident to record investment income directly from T3 and T5 slips. The process is fast, efficient, and often much simpler than preparing detailed working papers. But that raises an important question. Should this method always be used? The answer is no. Like many areas of accounting and taxation, the correct approach depends on the circumstances. Let's start with the green zone on the left side of the slide. This is where the T-slip method works best. Imagine a small owner-managed corporation with a relatively simple investment portfolio. Perhaps the company owns a few GICs, some dividend-paying investments, and receives only a handful of T3 and T5 slips each year. The transaction volume is low, the investment activity is straightforward, and the tax slips provide most of the information needed. In situations like these, the T-slip method is often the ideal solution. It is practical, efficient, and cost-effective. Now let's move to the yellow zone. This is where professional judgment becomes important. The investment portfolio may contain mutual funds with complex allocations, some capital gains transactions, fiscal year timing differences, or delayed T3 slips. The T-slip method may still work, but additional analysis may be required. The accountant must carefully evaluate whether the information on the slips is sufficient to prepare accurate accounting records. This is the area where experience and judgment play a significant role. Now let's look at the red zone. This is where detailed working papers are generally preferred. Imagine a large investment holding corporation with frequent trading activity, numerous purchases and dispositions, significant capital gains, foreign investments, and complex allocation issues. In these situations, relying solely on T-slips may not provide enough detail. The accountant often needs transaction-level analysis, gain and loss schedules, and detailed supporting documentation. This is where the working paper approach becomes much more valuable. Notice that the issue is not whether the T-slip method is good or bad. The issue is whether it is appropriate for the level of complexity involved. Now let's look at the warnings section at the bottom of the slide. This highlights one of the most common mistakes made when using the T-slip method. Suppose the corporation's bookkeeping records have already recorded $5,000 of interest income during the year. Later, a T5 slip arrives showing the same $5,000. If the accountant records the T5 amount again without checking the books, the income will be duplicated. The corporation now reports $10,000 of income even though only $5,000 was actually earned. This creates overstated income, inaccurate financial statements, and potentially incorrect tax reporting. That is why the question shown at the bottom is so important. Has the income already been recorded? Before entering any T-slip amount, the accountant must verify whether the bookkeeping records already contain that income. This simple check can prevent significant errors. The key takeaway from this slide is the message highlighted in the banner at the bottom: fast and efficient, but only when appropriate. The T-slip method is a valuable tool for simple investment portfolios. It can save considerable time and effort. However, it should be used thoughtfully and only when it provides enough information to support accurate accounting and tax reporting. The goal is not to use the fastest method. The goal is to use the most appropriate method while still producing accurate financial statements and an accurate T2 corporate tax return.